The world doesn't move when interest rates change. It jolts. Somewhere, right now, a group of people you've never heard of just made or lost more money in a single night than most cities earn in a year. No factories shut down, no laws passed, no elections held. Just a number, moved slightly, up or down, and trillions responded. That's the uncomfortable truth. Tiny changes in interest rates quietly rearrange the global economy while most of us are asleep. And today, that mechanism matters more than it has in decades. Because for the first time in a long time, rates aren't stuck near zero. They're moving again, fast. And every movement sends shockwaves through markets, governments, and your personal finances, whether you notice or not. Let's start with the part that sounds ridiculous. An interest rate doesn't feel powerful. It's just a percentage, 1%, 0.5%, sometimes even 0.25%. That's it. No explosions, no headlines that say everything just changed forever. And yet, when that number shifts, entire financial systems have to reprice reality. Here's why. Modern money is built on promises about the future. Loans, bonds, mortgages, credit cards, government debt, corporate debt. All of it is basically someone saying, "I'll give you money now and I'll pay you back later, plus a little extra." That little extra is interest, and interest rates are the ruler used to measure how valuable time itself is. When rates change, time gets repriced. Imagine you're promised $1,000 1 year from now. Is that worth $1,000 today? No, because time has value, risk exists, inflation exists. So you discount the future. You ask, how much is that future $1,000 worth right now? That discount depends on interest rates. Raise the rate, and future money becomes worth less today. Lower the rate, and future money becomes more valuable. Now scale that idea up. Not $1,000, trillions. The global financial system isn't reacting emotionally to interest rates. It's doing math. Cold, automatic, relentless math. And that math never sleeps. Let's say a government has issued $10 trillion in bonds. Those bonds promise fixed payments far into the future. When interest rates rise, those old bonds look worse. They pay less than new bonds being issued today. So their value drops, instantly. No debate, no negotiation. Markets simply mark them down. Now apply that logic everywhere at once. Banks, pension funds, insurance companies, hedge funds, foreign governments, sovereign wealth funds. They all hold massive piles of assets priced off interest rates. A small rate change doesn't move one thing. It forces everything to reprice at the same time. That's where the trillions come from. Not printed, not transferred, revalued. 1/4 point rate hike can erase or create trillions of value overnight because that value was always based on assumptions about the future. And assumptions just changed. Here's where it gets more unsettling. This process is mostly invisible. When a company loses $1 billion in market value after a rate move, no one goes bankrupt immediately. No one packs boxes, no sirens. But the damage or the benefit is real. Balance sheets weaken. Risk models break. Collateral becomes insufficient. Leverage suddenly looks dangerous. That's when stress starts leaking into the real world. Banks become cautious. Credit tightens. Hiring slows. Investments get delayed. All from a number that moved less than 1%. This isn't theoretical. We've seen it happen. In the early 1980s, U.S. interest rates were pushed above 15% to crush inflation. That decision reshaped the global economy. Developing countries that had borrowed in dollars suddenly couldn't afford their debt. Entire nations defaulted. A global debt crisis followed. More recently, after years of near-zero rates, the sudden tightening cycle in the 2020s triggered massive losses in bond markets. Assets once considered safe collapsed in value. Some banks didn't survive. And yet, to the average person, it just looked like a central bank announcement. Here's the quiet irony. Interest rates are supposed to be boring. They're designed to be a slow, stabilizing tool, a gentle brake, a cautious accelerator. But after years of financial engineering, leverage, and dependency on cheap money, the system has become hypersensitive, like a body that's forgotten how to regulate its own temperature. Touch the dial slightly, and everything reacts. Now let's talk about why this matters right now. Because the global economy is sitting on historic levels of debt. Government debt, corporate debt, household debt, all stacked on assumptions that rates would stay low for a very long time. Those assumptions are no longer guaranteed. When rates rise, debt doesn't just become more expensive, it becomes heavier. Refinancing gets harder, budgets get tighter, mistakes get exposed. Countries feel it, companies feel it. You feel it through mortgages, car loans, and credit cards. This is why central bank decisions are watched like live sports events by financial markets. Not because the people watching enjoy spreadsheets, because one sentence can move more money than any war, election, or invention. And here's the part that rarely gets discussed. No one is fully in control. Central banks influence rates, but markets interpret them. Investors front-run them. Algorithms amplify them. Sometimes the system reacts more violently than intended. A rate hike meant to cool things down can freeze liquidity. A rate cut meant to help can inflate bubbles. There's a fine line between control and chaos, and the line is thinner than most people realize. So when you hear that interest rates moved just a little, understand what that really means. It means the price of time changed, the value of future promises shifted, and trillions of dollars quietly rearranged themselves based on new assumptions, all without asking for permission, all without a vote. The world didn't change because someone panicked. It changed because the math demanded it. And the uncomfortable question is this: in a system this sensitive, how many small moves can it absorb before one of them breaks something we can't easily fix?
If you enjoyed this video, like, share, subscribe, and comment what topic you want next so I can explain it.